How does the debt-to-equity ratio influence investment risk and a company's financial valuation? Welcome back to the Plan Future Insight. I am Investment DADA, and today we are going to talk about a number that acts like a financial health barometer for any company you are thinking about. This is the debt-to-equity ratio. Let us start with a simple truth. The debt-to-equity ratio, or DE ratio, is your total liabilities divided by your shareholders' equity. Imagine this. You are buying a house worth 1 crore rupees. You put in 20 lakh rupees of your own money and borrow 80 lakh rupees from the bank. Your debt-to-equity ratio is 4.0. That is heavily leveraged. You own a small piece, but the bank owns most of it. That is exactly how a company looks when it has a high DE ratio. Now, here is how this ratio influences the valuation of a company in 4 critical ways. First, think about risk premium. This is the cost of leverage. A low DE ratio, say below 0.5, means lower financial risk. Investors are comfortable and they demand a lower return. That leads to higher valuation multiples, like a higher price to earnings multiple. On the other hand, a high DE ratio, above 1.5 or 2.0, signals higher bankruptcy risk. Investors will demand a higher return for taking that risk, which compresses the valuation multiples. For example, Company A in a sector has a DE of 0.3 and trades at a P/E of 25 times. Company B in the same sector has a DE of 1.8 and trades at a P/E of just 12 times. That is the power of leverage on valuation. Second, consider the impact on the weighted average cost of capital, or WACC. Debt is cheaper than equity because interest payments are tax deductible. But too much debt increases the risk of bankruptcy. There is an optimal zone, usually between 0.5 and 1.0 for stable companies. At that level, the WACC is at its lowest, which gives you the highest valuation in a discounted cash flow model. When the DE becomes excessive, the cost of both debt and equity rises, and the DCF value drops significantly. Third, look at earnings volatility. High DE means the company has fixed interest payments that do not go away when profits fall. During a downturn, those interest costs crush the profits. Investors see that instability and discount the earnings heavily, leading to a lower valuation. A company with low debt can weather a storm much better. Fourth, you must consider sector context. Never compare apples to oranges. Banks and NBFCs typically have a DE ratio of 8 to 15 times because borrowing money is their core business. Infrastructure companies might have 1.5 to 3.0 because they need capital for big projects. FMCG companies are cash-rich with low capital expenditure, so their DE is often 0.1 to 0.5. IT services are asset-light with high margins, so their DE is usually 0.0 to 0.3. Real estate companies carry heavy debt for land acquisition, so their DE is often 1.0 to 2.5. Always compare within the same sector. Now, here are Investment DADA's simple rules of thumb. For an equity investor, a DE below 0.5 is low risk and a quality business. You can pay a premium for that stability. A DE between 0.5 and 1.5 is moderate leverage. In that case, check the interest coverage ratio. It should be above 3 times. A DE above 2.0 is high risk. Only consider investing if the interest coverage ratio is above 4 times, the company has consistent cash flow generation, and the leverage is appropriate for its sector. My personal check is this. If a company has a DE above 1.5 and its revenue has been declining for 2 years, that is a capital erosion risk. Run your full framework because often the character pillar fails in such situations. Let me give you a quick calculation example. Company X has debt of 500 crore rupees and equity of 250 crore rupees, giving it a DE of 2.0. Its interest coverage ratio is 2.5 times, which is not great. Its return on equity is 18%, but that is boosted by debt, not by strong operations. The interpretation is clear. High DE with thin interest coverage makes this company vulnerable in a rising interest rate environment. That 18% ROE is artificially inflated by leverage. It is not genuine operational strength. When you value this company, you should discount its fair value by 15 to 20% compared to a peer with a DE of 0.5. Now, here is what you can do this week. First, For any stock you evaluate, check the DE ratio first. It is your initial risk filter. Second, always compare the DE against the sector average. Never look at it in isolation. Third, if the DE is above 1.5, always verify that the interest coverage ratio is above 3 times as a minimum. Dada's wisdom is this: debt is like fire. It can cook your wealth or burn your portfolio. The key is not avoiding it, but knowing when it is a tool and when it is a trap. A company with no debt is not necessarily strong. A company drowning in debt is definitely weak. Remember, investment in the equity market is subject to market risk. We do not claim any guarantee of return in equity-related investments. Past performance is not indicative of future results. You have the courage to ask the right questions. Now, go out there and build your future with confidence. This is Investment Dada, signing off. Until next time, stay wise and stay